Acsis is an independent financial services group that bases its financial planning and investment management philosophy on ongoing research and international best practice. To relook at the group's 2012 investment strategy, Cobie, it's Le Grange, isn't it?
Yeah, you're welcome. Welcome, absolutely. Le Grange,
I don't want to start by mispronouncing your surname completely, so do I go with Le Grange?
Yeah, that's fine. That's no worries.
All right. And considering you're a regular face on CNBC, that is unforgivable.
Well, listen, it's very nice to be, to be a guest this time around and not actually be a co-anchor or a co-host, which is fantastic. It's nice to be asked some questions this time.
Exactly. Well, let's see how you fare on this side. Your 2012 strategy.
Yes.
What have we seen to this point? Perhaps just take us a step back.
I think, Bronwyn, I think the first issue for me is, European debt crisis kind of played itself out last year. And in the beginning of May, I phoned a colleague of mine and I said, this European debt crisis is back, which is basically on a roadshow in January and February. I said to a lot of investors, listen, this thing might go front burner again, and you're going to have to put returns back on the back burner because this thing will become kind of center stage again and markets might become very volatile. And he said to me, oh, you know what? He said, returns in this whole Eurozone thing is so last year, and it is. But it's become center stage again. And I'm afraid that the defining moment for me this time around is that this thing's not going to go away. I was hoping on the back end of the Brussels Treaty in November last year, edging out of last year, that this whole thing we might actually just kind of get rid of it. We might eke out some growth out of Europe, and the thing will at least just provide some form of stability that you could actually now have an environment where you could buy
stocks. But that is a far cry from the reality.
Absolutely.
We are nowhere close to getting our way through this crisis, and perhaps just more negative news is set to unfold. We were talking earlier on the show saying that literally Europe is now staring down the barrel of a gun.
Yeah, and the best way to liken this is a whole bunch of guys in a company and they're sitting down, their business model's not working, they're indebted, and they literally have no idea how to deal with this, so they literally sit all day and meet and drink coffee.
Well, there we go. And the coffee is apt,
but
considering it's Europe.
There has to be a resolution now. You can't just go on with the market must either take Spanish debt to 12% spread or to 2% spread. Because if it goes to 12, then everything collapses, and if it goes to 2, everything's saved. There has to be a resolution. You can't just muddle along here.
You mean you can't just sit and drink coffee?
No,
for
you can't. Either the politicians will make a decision one way or the other, or the market will make it for them. So there has to be a resolution. It can't just muddle along.
Okay, but I think the important thing here is now, in light of this, one thing we're sure about: volatility, uncertainty going forward. Those are two terms that we're going to become very familiar with. And of course, we've already been throwing them around for a long period of time. Yeah. What do investors do in the current environment? Well,
I want to come back to what Wayne said just now, because Wayne said, listen, the market has to, either the market will make up will make up their minds for them, or something has to happen. And I'd like to say that'll be fantastic. If something can happen quickly and it's effective and something, and we could actually get a lot of the uncertainty out the way, we can go back and value companies, we can get the valuation models going again, and that would be fantastic. But in light of the fact that that might not happen, and we might actually just have a whole protracted process underway here. You've got to kind of start thinking about asset allocation. You've got to become a lot more nimble. That whole thing where you kind of think about buying and holding for the long term. I don't know how much that's going to apply going forward. You're going to have to become pretty nimble as far as asset allocation is concerned. Buy up into equities when there's decent opportunity, and then sell out again. And kind of be nimble about these things rather than kind of set out those kind of long-term asset allocations.
But isn't that really then trying to time the market?
Well, the fact is, look at the market. We kind of ended last year. Markets ran beautifully. January, February, March, April, appraising earnings. Certain companies more expensive than other ones. And we've literally just given up all those returns. Look at Anglo and Billiton. You're sitting at single-digit PEs. These things are fundamentally cheap. As a matter of fact, some of these, any lower, they're going to be sold like they're going out of business.
That's a valid point, that you should actually learn to trade the market.
Our market overall is not massively cheap. But within there, resources are very cheap, and then the retailers, SAB, etc., are very expensive. But overseas dividend yields are higher, the dividend yield percentages are higher than ours. Surely overseas markets must be reasonable value, but do you think anyone wants to buy specifically European markets? People want to buy German bonds at a 0% yield, but you don't want to buy equities that's giving you a 3-4% dividend yield. I think the market's totally wrong on this. I think the shares represent actually quite good value. The problem is they might even represent better value tomorrow because they can still fall.
And
That's the
don't
problem.
try and catch a falling sword. Isn't
Yeah.
that the old adage
Yeah, I
here?
mean, Mohammed Al Arain from PIMCO, which is obviously one of the largest managers in the world, he wrote a piece, an opinion piece this morning, which I'd rather say this afternoon, where he basically said, you know, if I look at equities, there's some fundamental value opportunities available. There's some cheapness in the market. But how do you deal with this in the face of the fact that you might have this European debt crisis that just literally blows up? Now, you know, I think going into the Greek election, I don't think there's going to be a massive blow up. I think the European Commission will sit down, they'll have an orderly type situation to this. They're European after all, you know, they're not savages.
But everybody has said that if it's an exit, it cannot. You can't put the term orderly into an exit and say that that is what's going to happen here. If it's an exit, by default, it's going to be
chaos.
disorderly. It's going to be chaos.
And that's why I'm saying asset allocation has to become nimble. You have to be nimble as far as these things are concerned. So you know that old adage, listen, I tell you what, just buy some really decent stock, and as long as the valuation is on your side, just leave it alone. It'll come to fruition. We might look back 5 years from now, and portfolio values might be exactly where they are still. And we might sit and say, well, best intentions, best everything that we've done, but quite frankly, this market has just gone
But
absolutely
this
nowhere.
flies in the face of long-term investing. I mean, how many fund managers have we had here saying, take it, buy it, looking cheap, put it away in your bottom drawer, look at it in 5 years?
I still think that holds, but actually we spend so much time talking about Europe because that's in the limelight. For our share market, China is way more important than what happens in China than actually what happens in Europe. If China holds together, buying Anglos and Billiton and other commodity shares at 7 PEs will be probably the best buy of the decade. You're probably going to make significant money. So the question really is, will China hang together? That's what I want to ask Cobie.
Yeah, I mean, I think the economists put together a fantastic academic literature around China. The problem is, as you know, that as China produces numbers, you don't quite know what you can trust and what you can't trust. But one thing that the economist numbers showed was that expenditure by government is much higher than it was for any comparable economy that could be likened to China. And they talk about kind of from there, from the big push, which is basically 1980, 1981, 1982 for that economy. Now, the one thing that could potentially push the Chinese economy through is the fact that they're sitting with trillions of dollars worth of bonds that they could potentially start liquidating and pushing back into the economy, and then therefore creating kind of a stimulus for that economy. That one would hope would continue happening, because what is the other thing happening for China? I mean, if they don't have demand for product, where is it? You know, where else are we going to find growth globally? Very, very difficult. So I'd probably bank on the fact that China will at least stabilize. You know, will we see the 9, 10, 11% growth rates out of this economy? Probably not. You're probably going to see like a 5% growth rate out of this economy. If it falls below that, that's still better than what you're going to see out of Europe. And then be nimble as far as asset allocation is concerned.
And that also goes to, I mean, you also think that China's going to stabilize. You've
Yeah.
never said you think that China's going to blow up.
Look, I mean, just as a matter of interest, maybe 3-4 times every 100 years, you've got to truly panic in investments. But when you're in investments, sometimes you feel like panicking every third day. So you've got to watch out for panic in markets. Panic's a terrible thing, you know. Excess pessimism, I think, is almost, it's probably more dangerous than excess optimism. But the one thing that gives me hope for China, and this is not 3 months, 6 months, 3 years, it's literally decades. What gives me hope for China is that the consumer has no debt. And that gives me hope. In other words,
Yeah,
they can
absolutely.
take
All right,
on,
now I
they
want
can
to-
spend a lot.
I want to test something else against you. So take into account the scenario you've put forward where you've got to look at the market and say, have you made enough upside? Maybe get out and don't hold on. That's really what you're saying.
Well,
Don't
you know,
hold on for...
You know, if you own 100 Rand in equities, don't sell all 100 Rand worth of equities. You know, raise some capital, some cash relative to that, and then be prepared to buy back in again when markets
All right.
come back to
So,
level.
so let me put this to you. South African retailers.
Yeah.
They have run very, very hard. They
Good.
defied all valuations out there. What should you be doing with them?
Good luck in owning those.
Good luck in owning them.
Absolutely. I think those values are relative to what you can buy internationally. Those are just unsustainable. It's
So
just
you're saying sell
unsustainable.
them now.
Well-
Take your money and run.
Well, you know, the problem that you've got with portfolio construction in South Africa is that you've got resources at the bottom end of the market. So the valuations at those levels are immensely attractive. In the middle, you've got the banks or financial services, and then right at the top end, you've got industrials, which you've showed a prime example in kind of showing retail stocks. Now, you've got those that are priced for absolute perfection at the top end of the market.
Yes,
They
but they
gotta
keep
come
defying
out-
the odds. They keep going higher.
Well, they got to come out. I mean, I have to argue that they got to come out with earnings numbers that would beat the market's expectations absolutely. You know, it's got to go over the top as far as these numbers are
But
concerned.
how about the other potential game changer, that we've got foreigners that deem our retail stocks to be cheaper than other emerging market stocks, and irrespective of earnings, they're going to continue to drive these stocks
Let's
higher.
look at general retailers. General retailers are sitting 24, 25 times earnings. You could probably pick up one slightly lower on the market sale. So for every share that you own, you've got to wait for 25 years worth of earnings in order to make back the price. That's a long
All right,
time.
so we're
to
going
wait.
with sell retailers, sell industrials.
Well, unless government policy shifts to such a point in South Africa where we're going to take the unemployment rate from 25% all the way back to 12% by next year, and we're going to get the middle class, literally doing this overnight. By all means.
Wayne, come help me out here. What should
No,
you? If you
I
are
think
holding,
we
you
should-
hold retailers. What are you doing
Very
with them?
little. No, you sell them.
Sell them. That's
look,
it.
Look,
It's
all
finished.
you can hold, all you can hang your hat on in investments is the valuation of the share today, because nobody knows what's going to happen tomorrow, and the shares don't represent value. But that was also the case a year ago. As you've spoken about, they've defied odds, but that's all you can hang your hat on.
We have run out of time. Cobie, we're getting you back. I like this robust debate that we're having. We've still got to chat about the resources. You tell me which one we should be buying. We're going to do that in the next couple of weeks, and thank you so much. Cobie Le Grange.
Thank you.
Have I got it right?
Thank you. Absolutely. Thank
He's
you.
an investment analyst at Acsis. And we also say goodbye to my guest host, Wayne McCurry from Momentum.